Larry. So, all right, this week the whole inflation conversation just kind of stopped in its tracks. What's the explanation for why?
Well, we're stuck in a moment. That's the best I could say. A recovery reckoning, as it were. I mean, when you consider the fact that core CPI 1.6%, and we have break-evens trading at 210. There's a big gap to be filled there, and I think the market just is stuck and just looking for the next bearish impulse to get yields higher. I'm not one of those who think, well, if yields can't go up, they must go down. However, when you consider the fact that we've proposed $1.9 trillion fiscal stimulus plan, Yellen is talking about issuing 50-year bonds. The stock market, is acting very well. S&P is above 3,800, ballooning Treasury issuance, not to mention Washington wanting to curtail bill issuance. So all that combined, like, what more do we need for yields to go up? And I don't know what that answer is other than inflation. So with that in mind, a drift lower in yields is probably in order, not because of gravity, but because of the amount of bearish impulses we've already had and nothing's happened.
So, Larry, the idea that the bond market is stabilizing above 1%, it seems like we're testing a little bit just how much the bulls can come back into this market. I've generally been biased towards the bearish side since this thing turned around in August. It seems to me like the easiest logic is that we're going to get back to normal when, not if, that if we got to an inflation of 2% to 3% within the past year and a half, which we did, then we're going to get to it on the other side of this when personal incomes are up since then. So to me, I would generally kind of look at this with a bearish tilt, but I got to say, I'm not too impressed by the bond bulls' attempt here. I mean, we're at 1.1. Seems like this gap above 1 was for real.
Yeah, and the first thing we have to keep in mind, there's an enormous amount of shorts in the market, those who are betting on yields going higher. So just intuitively, that has a natural stop to it. But at some point, with the bearish impulses that we witnessed over the past 2 weeks, and yeah, yields did rally quite a bit, but they couldn't get past that 119 area. And I think 115 was the closing high last week, and we closed 111 on Friday. When you consider equities being as robust as they are, the dark winter seems to be turning the corner. Inflation expectations are up, and the vaccine trajectory hasn't really altered the timeline. You'd think that yields should be at 125, and they're not. So I think there's more to the story, and I think we just need to see something other than just the bearish impulses I mentioned to get yields back to, above 119.
Okay. Now, Larry, in terms of economic data this week, we were pretty solid. We stabilized. We didn't have any big misses, but these really aren't the ones. It seems like it's really, at this point, core CPI, or core PCE, it's really just our set of specific inflation figures. The market's not extrapolating too much from other data. It's not extrapolating from PMIs. It's not really extrapolating, from jobless. It really just wants to see these pure inflation numbers, it seems, to move bonds.
Yeah, we have that, and we have FOMC, and I think consensus for CPI is 4.1 on the back of 33.4 in the third quarter. I have to say, I think rates will be less sensitive to a downside surprise because there's still a lot of unknowns. There's still so much that needs to come together, be cobbled together, and I don't think, I think CPI could definitely be a tradable event, but I'm not sure it's going to cast in stone the trajectory of yields in the short term. I think we need to see more unravel than just one CPI number.